Hello guys, welcome back to options trading series with Salman. So in my options trading series, I had uploaded the part 1 and 2 and now I shall be uploading the part 3. So in case you haven't watched the part 1 and 2, so I request you to go out and check this in my options trading playlist. So let's move on to the part 3 now.
In my previous videos we looked at the basic structure of a call option and understood the broad context under which we should buy a call option. In this video, we will formally structure our thoughts on the call option and get a firm understanding of both buying and selling of the call option. Before we move further in this video, here is a quick recap of what we learned in the first video. It makes sense to be a buyer of a call option when you expect the underlying price to increase. If the underlying price remains flat or goes down, then the buyer of the call option loses money. The money the buyer of the call option would lose is equivalent to the premium agreement fees the buyer pays to the seller/writer of the call option. We will keep the above 3 points in perspective, which serves as basic guidelines, and understand the call option to a greater extent. Building a case for a call option. There are many situations in the market that warrants the purchase of a call option. Here is one that I just discovered while writing this video, though the example would fit well in the context of our discussions. Have a look at the chart on screen. The stock in consideration is Bajaj Auto Limited. As you may know, they are one of India's biggest manufacturers of two-wheelers. For various reasons, the stock has been beaten down in the market, so much so that the stock is trading at its 52-week low price. I believe there could be an opportunity to initiate a trade here. Here are my thoughts with respect to this trade. Bajaj Auto is a quality fundamental stock, there is no denying this. The stock has been beaten down so heavily, which makes me believe this could be the market's overreaction to volatility in Bajaj Auto's business cycle. I expect the stock price to stop falling sometime soon and eventually rise. However, I do not want to buy the stock for delivery yet, as I'm worried about a further decline in the stock. Extending the above point, the worry of M2M losses prevents me from buying Bajaj Auto's futures as well. At the same time, I don't want to miss an opportunity for a sharp reversal in stock price. To sum up, I'm optimistic about the stock price of Bajaj Auto, the stock price to eventually increase, but I'm kind of uncertain about the immediate outlook on the stock. The uncertainty is mainly because my losses in the short term could be intense if the weakness in the stock persists. However, as per my estimate, the probability of the loss is low, but nevertheless, the probability still exists. So what should I do? Now, if you realize I'm in a similar dilemma that AJ was in the new example from first video.
You need to hedge.
A circumstance such as this builds up for a classic case of an options trade. In the context of my dilemma, buying a call option on Bajaj Auto makes sense for reasons I will explain. Here is a snapshot of Bajaj Auto's option chain. As we can see, the stock is trading at 2026 rupees and 90 paise, highlighted in blue. I will choose to buy the 2050 strike call option by paying a premium of Rs 6.35/, highlighted in the red box and red arrow. You may be wondering on what basis I choose the 2050 strike price when in fact there are so many different strike prices available, highlighted in green. Well, the process of strike price selection is a vast topic on its own. We will eventually get there in this module, but for now, let us just believe 2050 is the right strike price to trade. Intrinsic value of a call option upon expiry. So what happens to the call option now, considering the expiry is 15 days away? Well, broadly speaking, there are 3 possible scenarios which I suppose you are familiar with by now. Scenario 1. the stock price goes above the strike price, say 2080. Scenario 2, the stock price goes below the strike price, say 2030. Scenario 3, the stock price stays at 2050. The above three scenarios are very similar to the ones we had looked at in video 1. Hence I will also assume that you are familiar with the pen calculation at the specific value of the spot in the given scenarios above. If not, I would suggest you read through video 1 again. The idea I'm interested in exploring now is this. 1. You will agree there are only 3 broad scenarios under which the price movement of Bajaj Auto can be classified. Upon expiry, i.e. the price either increases, decreases, or stays flat. 2. But what about all the different prices in between? For example, as per scenario 1, the price is considered to be at 2080, which is above the strike of 2050. What about other strike prices such as 2055, 2060, 2065, 2070, etc.? Can we generalize anything here with respect to the pen? 3. In scenario 2, the price is considered to be at 2030, which is below the strike of 2050. What about other strike prices such as 2045, 2040, 2035, etc.? Can we generalize anything here with respect to the pen? What would happen to the pen at various possible prices of spot upon expiry? I would like to call these points the possible values of the spot on expiry and sort of generalizing the pen understanding of the call option. In order to do this, I would like to first talk about, in part and not the full concept, the idea of the intrinsic value of the option upon expiry. Going by the above formula, let's evaluate the pen for a few possible spot values on expiry 2023, 2072, 2055. The solution is as follows at 2023 max, 0, 2023 to 2050, dash 6.35 equals max, 0, minus 27, dash 6.35 equals 0 to 6.35 equals dash 6.35. The answer is in line with generalization 1, loss restricted to the extent of premium paid. At 2072 max, 0, 2072 to 2050, dash 6.35 equals max, 0, plus 22, dash 6.35 equals 22 to 6.35 equals plus 15.65. The answer is in line with generalization 2. Call option gets profitable as and when the spot price moves over and above the strike price. At 2055 max, 0, 2055 to 2050, dash 6.35 equals max, 0, plus 5, dash 6.35 equals 5 to 6.35 equals minus 1.35. So, here is a tricky situation. The result of what we obtained here is against the second generalization. Despite the spot price being above the strike price, the trade is resulting in a loss. Why is this so? Also, if you observe, the loss is much lesser than the maximum loss of RS 6.35/. It is in fact just RS 1.35/. To understand why this is happening, we should diligently inspect the pendulum behavior around the spot value, which is slightly above the strike price, 2050 in this case. As you notice from the table, the buyer suffers a maximum loss, 6 rupees and 35 paise in this case, till the spot price is equal to the strike price. However, when the spot price starts to move above the strike price, the loss starts to minimize. The losses keep getting minimized till a point where the trade neither results in a profit or a loss. This is called the break-even point. The formula to identify the break-even point for any call option is break-even equals strike price plus premium paid. For the Bajaj Auto example, The break-even point is equals 2050 plus 6.35 equals 2056.35. In fact, let us find out depend at the break-even point max 0 2056.35 to 2050 dash 6.35 equals max 0 plus 6.35 dash 6.35 equals plus 6.35 to 6.35 equals 0. As you can see, at the break-even point we neither make money nor lose money. In other words, if the call option has to be profitable, it not only has to move above the strike price, but it has to move above the break-even point. Call option buyers payoff. So far we have understood very important features with respect to a call option buyer's payoff. I will reiterate the same. The maximum loss the buyer of a call option experiences is to the extent of the premium paid. The buyer experiences a loss as long as the spot price is below the strike price. The call option buyer has the potential to realize unlimited profits provided the spot price moves higher than the strike price. Though the call option is supposed to make a profit when the spot price moves above the strike price, the call option buyer first needs to recover the premium he has paid. Call option buyer completely recovers the premium he has paid is called the break-even point. The call option buyer truly starts making a profit only beyond the break-even point, which naturally is above the strike price. Interestingly, all these points can be visualized if we plot the chart of the pen. Here is the pen chart of Bajaj Auto's call option trade. From the chart you can notice the following points which are in line with the discussion we have just had. The loss is restricted to Rs 6.35/ as long as the spot price is trading at any price below the strike of 2050. From 2050 to 2056.35, break-even price, we can see the loss is getting minimized at 2056.35. We can see that there is neither a profit nor a loss. Above 2056.35, the call option starts making money. In fact, the slope of the pendulum line clearly indicates that the profits start increasing exponentially as and when the spot value moves away from the strike again. From the graph, one thing is very evident. A call option buyer has limited risk but unlimited profit potential. And with this, I hope you are now clear with the call option from the buyer's perspective. In the next video, we will look into the call option from the seller's perspective. Key takeaways from this video. It makes sense to be a buyer of a call option when you expect the underlying price to increase. If the underlying price remains flat or goes down, then the buyer of the call option loses money. The money the buyer of the call option would lose is equivalent to the premium, agreement fees, the buyer pays to the seller/writer of the call option. The intrinsic value, 4, of a call option is a non-negative number. 4 equals max 0, spot price, strike price. The maximum loss the buyer of a call option experiences is to the extent of the premium paid. The loss is experienced as long as the spot price is below the strike price. The call option buyer has the potential to make unlimited profits provided the spot price moves higher than the strike price. Though the call option is supposed to make a profit when the spot price moves above the strike price, the call option buyer first needs to recover the premium he has paid. The point at which the call option buyer completely recovers the premium he has paid is called the break-even point. The call option buyer truly starts making a profit only beyond the break-even point, which naturally is above the strike price.
Yeah.